we go. So welcome here to our live session. So I wish we could be in class face-to-face, but obviously that's not going to work this semester. But don't worry, we'll make the best of it. This class will do just fine online. So what I'm going to do tonight with you is to go over chapter 16 plus answer any questions you've got. So let me go ahead. Oh, I see David and Ben are both there. Okay, good. So I'm going to go ahead and share my screen here. And specifically what I'm going to share be the chapter 16 notes. So introduction to management accounting. And what we're going to do here is to get acquainted with what management accounting or managerial accounting is. And we'll see some concepts coming from it. And a lot of those concepts during the course are set in the context of manufacturing. So we'll get acquainted with manufacturing as well. Not that most of you will be working in manufacturing, but instead it's just a good pedagogical tool. And it includes everything that we need for almost all the course. It's very easy to relate to, and I don't think you'll have any trouble with it. So you may have gotten to see the video that I recommended to you, which is about Legos. So manufacturing Legos. And if not, that's okay. You can watch whenever you have a chance. And you may have gotten a chance to look at manufacturing in person, such as a factory tour. If you did, that's great. And there are certainly many around. In fact, it's always a good thing to do on vacation, to tell you the truth, because seeing how something is made is always inherently interesting. Yeah, probably the most common factory that I find students have been in is the Hershey factory in Hershey, Pennsylvania. So if you've been there, you've seen manufacturing in action. So here in chapter 16, looking at the introduction to management accounting, and by the way, almost everything in this chapter is non-computational, I first talk about management accountability. And we're there to help managers with the actions that they are accountable for. Because in managerial accounting, we will be providing information internally, in other words, to help management better run the company. So management accountability, and that's really management's responsibility to various stakeholders of the company. So we think stockholders, first of all, and yes, indeed. Also creditors, and also internal users, such as employees. And back in the course that you just took, 2111, you study financial accounting. And that's information for external stakeholders. But this semester, we're going to switch gears to managerial accounting or management accounting, and we're going to prepare information for internal purposes. And when you have a chance, we'll take a look at the contrast between financial and management accounting on page 860 of the book. I'm going to go ahead and show you that on my screen. And by the way, can everybody see? Whoops, my screen. Okay, let me go back to the book here. There we go. Anybody having trouble? Okay. Again, please.
Can't see your screen.
You can?
We cannot.
Cannot. Okay. Let me fix that. Oops, that's because I forgot to press the share button. Whoops. Okay, can you see it now? Oh,
Yeah, not good.
Yes.
Print may be a little bit small there on a laptop like mine. But on page 860 of your book, you can just listen here if you can't see it too well. Well, since we've all studied financial accounting, we are familiar with it, and I'd like to tell you the differences between that and managerial. First of all, with financial, in the way of primary users, we have external stakeholders. So stockholders are investors, to a lesser extent creditors, governmental entities. So for example, if Florida Southern, one governmental entity that we're very concerned with is the Department of Education. And we have a lot of compliance requirements with it. But then as we talk about managerial accounting, we're concerned about internal users. So the company's management, employees for the most part. So we're definitely shifting gears in this class, and most people like that shift. Then the purpose of the information. Well, back in financial, let's help investors and creditors make investment and credit decisions. But here in managerial, we're all about planning, decision-making, control, analysis. So we'll help managers and employees plan, direct, and control operations. And then the focus on the time dimension of the information. Well, in financial accounting, we're focused on the past. So we talk in financial statements about historical information, including the historical cost principle, of course. So we're reporting what actually has occurred in the past. But in managerial accounting, we think about the past, we think about the future, we think about the present too. So we're much more open in terms of dimensions of time. Then with rules and restrictions. Well, in financial accounting, we are controlled by GAAP, generally accepted accounting principles. So we do something which is in accordance with GAAP, or we do not do something because it's not in accordance with GAAP. So GAAP rules us. In managerial accounting, we talk very little about GAAP. It will rule very few things that we discuss. Instead, what does rule is company policy. And there's enough common ground in the way of best practices that we certainly have a lot of information in the course to share. So we see some variation from company to company, but we'll cover the common ground in this course. Then scope of the information. Well, in financial accounting, primarily very summarized information. Information which is aggregated over the company as a whole. It's not broken down into detail that much. However, in managerial accounting, we will break things down into detail. So details such as time, we might break things down into weeks even, or days. We might break things down store to store, or even employee to employee. For example, Publix is very good at that, and they prepare an income statement for every one of their stores every week. And it's very detailed, going into individual departments, individual products. And one manager there told me that even if they know that a store has a spoiled key lime pie that they've thrown out from the bakery, headquarters will know about it. So extremely detailed. And then finally, behavioral. Well, we're not that concerned about behavioral aspects in financial, but we will be in managerial, because what we do here does affect human behavior. So we'll talk about some behavioral aspects from time to time in the course. I think you'll find those to be very interesting. Any questions so far? Again, if you have questions, just let me know. Well, see, as I said, management accounting information is going to help management with its planning and controlling functions. And management accountants are expected to conform to high ethical standards. And there is a statement of a code of ethics from the Institute of Management Accountants in your book. Just glance at it when you have a chance. And beyond that, I won't be concerned about it. Just see something real quick. Good. And you all can see my screen in terms of the outline, right? Okay, good. So next thing I'd like to discuss are some cost terms. And The upper division title of this course, by the way, is Cost Accounting. So very appropriate that we see some different cost terms here. First of all, why is it cost? Well, we give something up. So it's usually described as a sacrifice of economic benefits. And accounting is normally based on historical costs. So something in the past. Usually that's based on the expenditure of cash, so we gave some cash up, or we incurred a liability, which we'll pay in cash later. Now, accounting, at least financial accounting, is not based on opportunity or economic costs, excuse me, which are the incremental benefits of a foregone alternative over the alternative chosen. So let's say that we purchased a direct material, which is going to be a component of the product we manufacture, from a supplier. Let's say that we were purchasing lumber and we paid a supplier or someone we bought it from $5 per board foot of lumber. Well, we later find that we could have gotten the exact same product from another vendor for $4 per board foot. That means we had an opportunity or economic cost of $1 per board foot. So we gave that up. Financial accounting doesn't look at that. They're concerned about the actual historical cost. But here in managerial, if we're trying to help managers better run the company, we do look at opportunity costs like that, because we're going to try to guide management toward that more inexpensive opportunity there. Then the term cost object in B. It's anything for which a separate measurement of costs desired. And an example is a product produced. In the next chapter, we will get into how we cost a product we produce, and we can use cost as a verb. So we'll see how we add up the inputs going into it, which, by the way, we'll see a little bit later in this chapter. They will be direct materials, direct labor, and overhead. You don't have to write those down, but those terms may sound a little bit familiar. Then see the term cost accumulation. It means recording cost in an accounting system and aggregating the data in an account. Costs are then assigned or allocated or applied, all mean the same thing, to cost objects to provide management with needed information for decision-making purposes. We'll do that with just a moment with indirect costs. So let's look at D, one way in which we could categorize costs as direct or indirect. Well, direct costs of a cost object are easily related to it. They can be traced to it in an economically feasible way. So in a little bit, we will see direct materials and direct labor. We will know the exact amount of each of those that each product is consumed, the exact cost. We'll worry about those costs in chapter 17, the next chapter. But in this chapter, I just want you to absorb some ideas. Then number 2, indirect costs of a cost object. They're related to the individual cost object, but they can't be traced to it easily. They will be accumulated in cost pools. They'll then be allocated to the cost object using an averaging system. We're going to be doing that for overhead. Again, in chapter 17, I will show you the process with numbers. But for overhead, we have things in there such as depreciation on the factory building, depreciation on the equipment, property taxes on the factory, costs that we just can't easily trace directly to an individual product and say, aha, we know the exact amount of property taxes this product is consumed, or the exact amount of depreciation this product is consumed. We just can't do that. So instead, we have to pool all these costs together in one big overhead account and then allocate or average out overhead. And we will see the numbers for that in chapter 17. As we average out overhead, we will give each individual unit of the product a little dose of overhead cost. So that's how we will handle that. Again, I just want you to grasp the idea for now. Then E, another way that we could categorize costs would be is capitalized versus non-capitalized. By the way, capital refers to asset. So if a cost is capitalized, it is recorded as an asset. So we see that in number one, the capitalized costs have future benefits. They're thus capitalized or recorded as assets when incurred. And two different types of capitalized costs. Well, capitalized inventoriable costs, which are also called product costs, pertain to products. They become an expense, namely cost of goods sold, when they are sold, when those finished products are sold. So with capitalized inventoriable costs, we will be seeing direct materials, direct labor, and overhead. So again, more about the numbers in chapter 17, but those are the three big costs in a factory. Then if something is not inventory, but it is an asset, it will be B, capitalized non-inventoriable costs. They pertain to assets other than to products. So any other asset is a capitalized non-inventoriable cost. So it could even be cash, or it could be a computer, or a piece of furniture, or a machine in a factory, or the factory building, or land. None of those are inventory, but they're all assets. They're all capitalized. Then number two, non-capitalized costs have no future benefits and they're thus expenses. And an expense is also called an expired cost or a period cost, or they could be losses. I'm not too concerned about the difference between an expense or a loss in this class. Then number three, one type of non-capitalized cost is an operating cost or operating expense. They're non-capitalized costs which are incurred to generate revenue. And operating costs, you'll see this in your book, include upstream and downstream costs and the periodic expensing of capitalized non-inventoriable costs which are consumed, such as depreciation. And many companies also classify cost of goods sold and operating cost. Your textbook doesn't. It doesn't really matter for us because we know for all expenses, we do deduct those from revenue to generate net income. I will show you in just a bit. I will also tell you more about that value chain in just a moment. Then F. Another way that we could categorize costs is as variable or fixed. And you may have seen these in economics. So if you did, well, you will know in number one that variable costs change in total as a company's volume changes. We could express that volume as either number of units produced or number of units sold. By the way, if we assume a just-in-time inventory system, which we will study later, in which we produce inventory just in time to sell it, then the number of units produced on the assembly line would exactly equal the number of units sold. So variable costs, they go up as we produce more units, and as we produce fewer units, they go down. Direct materials is a good example of a variable cost. So direct materials, for example, let's say that my shirt consumes 1 square yard of fabric. That would be a direct material. If the fabric costs $10 per yard, well, if we produce one shirt, we incur $10 of variable cost for direct labor. Produce 2 shirts, $20, 3 shirts, $30, and on it goes. So that variable cost of direct materials will go up as the number of units we produce goes up too. Then, if you've seen these in economics, you also saw fixed costs. And they don't change as the company's volume changes. They're just flat out fixed. So if we thought about property taxes I mentioned a moment ago, that would be a good example of a fixed cost. The total amount of property taxes will not change no matter how many units we produce. Straight line depreciation is also a fixed cost. It does not depend upon the number of units produced. However, there's one type of depreciation that's a variable cost, And that is units of production depreciation, which you'll remember from financial accounting. Because the more units we produce, the more depreciation we have. Now, number 3, these relationships will hold true within the company's relevant range, or in other words, feasible limits of production, within the short run, which is generally 1 year or less. So as we think about the company's relevant range, and again, you covered this in economics if you had that, these are the feasible limits of production within a year. So if our factory can produce from 5,000 to 20,000 units per year, that would be our relevant range. If we would like to produce more than that, we must add on to our fixed factory facilities. Or if we want to produce less than that, we will reduce our fixed factory facilities. So we always assume that we're within the relevant range. And number 4, we can note that total variable cost is mostly a function of units. Because again, the more units we produce, the more total variable costs go up. Whereas total fixed cost is mostly a function of time. Because the more time that goes by, the greater total fixed cost will be. For example, if property taxes are $12,000 per year, that means they would be $1,000 per month. So in that case, the shorter the time frame, the less variable cost we have. The less fixed cost we have. And we can also note the total variable cost is controllable by a manager within the short run. Total fixed isn't. The total variable is, because that manager could decide whether to produce more units or fewer units. Then G, the term cost driver. Well, it's any factor which causes a cost to change in total, and will often arise as an allocation base for indirect costs. We'll see that in the next chapter. Also known as a cost determiner or cost generator, cost drivers thus link an indirect cost to a cost object. Cost drivers can be financial or non-financial in nature. So in the next chapter, we'll see cost drivers such as number of units we produce, or number of hours of direct labor, or number of machine hours working our machines on the assembly line. As these things go up, our total variable costs will go up too. So again, such as if we produce more units, total variable cost goes up too. Then lastly in this section, I've got the value chain, and that's a means of dividing costs into the following. Well, before we even get to manufacturing, we're going to incur some pre-production costs, also known as upstream costs, just like on a river. And these are incurred for research and development and product design. So that's where our engineers come in. Research and development to identify a product, and product design to get it ready to manufacture. After that, we can go to the assembly line. We can manufacture the product. We can make it. So manufacturing or product costs, these are incurred on the assembly line and are direct or raw materials. Two terms are pretty much synonymous: direct labor and factory overhead. But then after we manufacture a product, we've got some post-production or downstream costs. And these are incurred for marketing, so selling our product, distribution, getting it out to the customer, and customer service activities such as warranties. And what we will bear in mind as we go through the course is all pre-production and post-production costs or expenses incurred. Manufacturing costs are capitalized as a part of the cost of the product manufactured, and they will be expensed at the point of sale as cost of goods sold. So let me pause there. Does anybody have a question? I realize this was pretty much definitional so far. We're okay. All righty. What I would like to do is to go to the end of this outline, and I've got some little multiple choice questions here that we can answer together. So let's see which ones I can do so far. I can do number 1 so far. Grace & Company's management desires cost information regarding their shipping department. So if they do, that shipping department would be an example of a cost what? Any idea? Okay, it's D, cost object, because we want a separate measurement of cost. Let me wait on 2 and 3. And I can do 4 and 5 with you at this juncture. We have enough information. So all this information will pertain to 4 and 5. Let me see what 4 and 5 are asking before I read through the other information. So first, 4 is asking about cost drivers. Number 5 is asking about variable cost. So with that in mind, let me come back to salaries. $400,000, all employees are on guaranteed contracts, so they get the same amount of salary no matter how many hours they work. So first, would you say salaries are variable or fixed? Fixed. Yes. And the cost driver there would be number of employees. So I'm answering whether each one is variable or fixed and what the cost driver is. So cost driver, number of employees, and again, a fixed cost. Then packaging, $200,000 varies with weight of items shipped. So would you say the packaging is a variable or fixed cost?
A variable.
Variable, good. And the cost driver would be weight. Postage, $200,000, varies with weight of items shipped and distance of shipment. So almost like packaging, that's another variable cost. We see 2 cost drivers there. We've got weight and we've got distance. Then renting the warehouse space, $100,000, that's an annual lease. Would you say that's variable or fixed? Fixed, does not depend upon number of units produced. And the cost driver we can say is time. So annual lease, that's for 1 year. 1 month of rent expense would be 1/12 of that. So in number 4, all the following are possible cost drivers for mail order clothing's shipping department, except it would be D. Number of hours shipping personnel work, because that doesn't matter. They get the same amount of salary no matter what. By the way, we will see during the course that salaries are generally fixed, whereas wages are generally variable. With the wage, you get a greater paycheck with every hour that you work. Not so with the salary. Then number 5, mail order clothing shipping department has variable costs of, well, we saw 2, packaging and postage. That would be $400,000. If we were asked about total fixed, that would be $500,000. Then you can do number 7,
How much did you say the total variable cost was?
$400,000. Then number 7, the book value. And just refreshing our memory from financial accounting, that means original cost less accumulated depreciation of machines used in a manufacturing plant. Well, is a non-inventoriable cost? The answer is yes, it's non-inventory. Is it an inventoriable cost? The answer is no, because it's not inventory. Is it a capitalized cost, or in other words, an asset? The answer is yes. So our answer in number 7 is C. Yes, no, yes. And let me see if I can do anything else with you based on, whoops, blank page there, based on what we've seen at this juncture. And not yet. Okay, let me come back to where I left off up here. So we were just ready for Roman numeral 3, and then after this, we'll answer some more of those questions. So I've got the service, merchandising, and manufacturing sectors. three sectors into which we can divide companies. And back in financial accounting, you saw the service and merchandising sectors. But in this course, we're going to introduce the manufacturing sector too. Well, let's talk about service sector companies first. That was the first type of company that you covered in financial accounting. The reason is the income statement and balance sheet are very simple. And most companies here in the United States are service sector companies, such as plumbers, electricians, most small businesses we could think of. So, service sector companies sell services to generate revenue. They have no product cost because they've got no inventory. They're simply selling a service instead. Labor is usually by far the most significant operating cost. They thus have only non-inventoriable capitalized costs. In other words, assets other than inventory. And non-capitalized costs are expenses. And we can note the non-capitalized costs will not include cost of goods sold because, again, there's no inventory. But they may include upstream and downstream costs. So there's an income statement in your book, calculation of a unit cost in your book. But I'll tell you, this little simple example I've got here will do just fine for us. If I had net sales revenue of $750,000, then I wouldn't have any cost of goods sold. I would simply have some operating expenses of $525,000. I'm assuming these numbers. So the difference would be operating income of $225,000. So again, a simple little income statement, no cost of goods sold. But then if we think about a retailer, that's a perfect example of a merchandising sector company. And they purchase inventory from vendors and resell it to customers to generate revenue. They thus have non-capitalized inventoriable costs, in other words, merchandise inventory, non-inventoriable capitalized costs, so assets other than inventory, and non-capitalized costs or expenses, which would be cost of goods sold. And since we expense all upstream and downstream costs incurred, they would also be operating expenses, or we could say upstream and downstream expenses. There's an example of the income statement in your book, but here's a simple one for us, which will be just fine. First of all, I'm assuming net sales revenue of $950,000. By the way, net sales revenue is referring to gross sales revenue less cash discounts, terms like 210 net 30, pay within 10 days, you get a 2% discount. That is a so-called contra sales revenue account for that 2%. And also net sales revenue, we subtract, sales returns and allowances from gross sales revenue to get net sales revenue. Sales returns and allowances being another contra sales revenue account. For example, if we return something in a store, that's a sales return. So net sales revenue, gross sales revenue minus any contra sales revenue accounts, just to clarify. Well, then we do subtract cost of goods sold, which in this case is $250,000. I assumed here these numbers. So first I charted out where inventory came from during the year. Either it was on hand as beginning inventory, which was last year's ending inventory, or we purchased it during the year, $700,000. That gives us cost of goods available for sale of $900,000. So there's the total array of goods that we have to sell at some time during the year. Again, we know where it came from. Either it was on hand as beginning inventory or we purchased it. Now we chart out where inventory is going. Either it will be on hand as ending inventory, and we count inventory year end, it happened to be $650,000, or it will have been sold. So the difference is $250,000 of cost of goods sold. And if I have a typo there. If I subtract that, I know what this was supposed to be. Pardon me. Whoops, I have a typo. Okay, let me just double check my math here. First time I've used this example. All right. So this should be, sorry, that should be 700,000. So please make that correction. And if we subtract that, if we subtract operating expenses from that, we're going to be left with not a negative figure net loss, but instead we're going to have 350,000 as operating income. Okay, there we go. So let me ask, any questions so far? All righty. So now let's turn to the sector that we barely scratched back in financial accounting, and that is the manufacturing sector. We didn't dwell on it back in 2111 because we introduced it here in 2112 instead. It's a little bit more complicated, so that's why we saved it. But again, it's a good pedagogical tool for us here. So as we think here in C about manufacturing sector companies, well, factories. They produce the inventory they sell in order to generate revenue. I'm not going to be concerned about the balance sheet and income statement at this juncture, but just to let you know where they are in the book. Same thing with Exhibit 16.5. Glance out when you have a chance. Well, what I would like for you to know is here, the manufacturing sector company, raw materials, also known as direct materials, are purchased from a vendor, someone that sells those to us. They are then transformed into finished goods. So for example, manufacturing furniture, a company will take wood, nails, screws, varnish, paint, etc., and transform those raw or direct materials into finished furniture. So that's a good example of what happens if we have a manufacturing sector company, and we'll discuss more about what goes on the assembly line after a while. But these companies have capitalized inventoriable costs, which are direct materials, work in process, and finished goods inventories. They also have non-inventoriable capitalized costs, so assets other than inventory like machines, and non-capitalized costs, so expenses, cost of goods sold, and the upstream and downstream costs. So here are some costs which are accumulated as product costs for a manufacturing company. So we talked about direct costs just a little bit ago, and here's an application of that, a direct manufacturing cost. It can be easily traced to a finished good. Well, we've got here a couple of them. We've got direct labor first. So, easily traced to a finished good. Direct labor, by the way, refers to an assembly line worker working on the product. So if we know the time they worked on the product and we know their wage rate, we can multiply. That gives us direct labor cost. We'll be doing that with numbers in the next chapter. So that's why I say direct labor primarily includes assembly line workers. By the way, if labor is not directly traceable, it's going to be classified as indirect labor, which is a component of factory overhead, or in other words, indirect manufacturing costs. Again, I will show you numbers in the next chapter, just absorbing concepts for now. Well, a few notes about direct labor. First of all, direct labor includes the worker's basic wage rates, and it usually includes their fringe benefits as well, except for overtime premium. That's going to be a part of overhead. So overtime premium, if you work more than generally 40 hours per week, it's said that you get time and what? Anybody know? Time
and a half.
Okay, good. So if your basic wage rate is $10 per hour and you work an hour of overtime, you work 41 hours. For that hour of overtime, how much money will you get in total? No one? $15. You will get the basic wage rate of $10 per hour plus overtime premium of $5. The overtime premium is the half. As it turns out, the $10 will be a part of direct labor. The $5, as we'll see in the next chapter, will be a part of overhead. So we subdivide it that way. In fact, I can write that down here and just flash it up here on the screen. So let's see there, if you can see that. Oops, yeah. So $15, how do we divide that? So we get 15 bucks for this 41st hour that we worked. Well, direct labor is going to be the basic wage rate still of $10. Overhead will be the overtime premium, so the extra you get, which is 5 bucks. Piece of paper does pretty well instead of a board. So does that make sense? Of course, the good thing about recording this is that you can always watch it later if you need to. Well, then in the second little note, excuse me, most direct labor is variable, but some could be fixed as well. For example, an assembly line worker could be paid whether or not there's any work for him or her. As with a flat salary or a fixed contract, just like in questions 4 and 5 that we just saw in the example. But for simplicity, we will assume that all direct labor is variable unless otherwise indicated. So again, generally a wage is variable, a salary is fixed. And third little note, direct labor does not include the cost of any supervisor's labor. Instead, that will be a part of overhead. So if we see a supervisor or a factory foreman or something of that nature, that will generally be a part of overhead because that person is not working directly on the assembly line and directly on the product which is being manufactured. That's why. So again, their labor is classified as indirect labor, and that's component of factory overhead. So more about that again in the next chapter. And like I said, generally the term wages implies variable direct labor because workers are paid an hourly wage, and the term salary implies fixed direct labor. Well then, our other direct cost is direct materials. And those are materials which are transformed into finished goods. So again, just like lumber being transformed into finished furniture. Direct materials are directly traceable to the finished goods in a relatively easy manner. Just like direct labor, we know exactly how much cost in the way of direct materials each product is consumed. By the way, materials used in production which are not directly traceable or a part of factory overhead, they are called indirect materials or manufacturing supplies. For example, cleaning supplies for the factory, lubricants for the machinery, new blades for a saw on the assembly line if we have lumber. All those things are a part of overhead. So we can't trace the exact amount, let's say, of cleaning supplies for the factory, each unit of the products consumed. That's why we will lump them into this big cost pool called overhead, which will comprise all kinds of different manufacturing costs, which are not direct labor and are not direct materials. So again, we'll see that work in the next chapter. Well, then number two, just a little bit about indirect manufacturing costs. We know they cannot easily be traced to finished goods, also known as a factory overhead. Some will be fixed, some will be variable. For example, one type of indirect manufacturing cost or overhead will be electricity, so the power bill. Well, some power usage is fixed, like lights in the factory. You have to light it up, no matter if you produce units or not. Much air conditioning, you have to air condition the factory whether or not you are producing units. Those would be fixed costs. Also, the fixed monthly customer charge, usually about $10 or so, is another fixed cost. But then the rest of electricity usage is variable. So as we produce more units, electricity, at least that variable component, is going to go up too. Does that make sense? So some overhead will be fixed, some variable. Again, more about that in the next chapter. Well, then in contrast, both direct labor and direct materials are variable unless you're told otherwise, as they may be partially or totally fixed in some special cases. Again, you would have to be told. An overhead is allocated to units produced by an averaging process after it's accumulated in an overhead control account, which is that big cost pool. So numbers for it in the next chapter, but again, just ideas for now. An overhead may also include some items which could technically be traced as a direct cost, but are so immaterial as to not warrant the extra effort, such as the small amount of glue applied to products. We saw a little bit of glue in the Lego video, which was applied to glue on the heads of the Harry Potter Legos. So that could qualify here. Or we saw a little bit of ink being stamped on the faces of Harry Potter, and they had some other characters there too where they were stamping ink on the faces. So those we could say are technically direct materials, but I'll tell you it's easier to just lump them into overhead. We'll see why in the next chapter. And they're not very big, so that's why we're not worried. Then overhead also includes, as we saw, overtime premium, like the extra $5 per hour that you get for working overtime. It also includes the cost of idle time. So idle time means that people are just sitting around. It could be that our assembly line is down for some reason, maybe a machine's broken on it, and we're allowing them to sit there or paying them until it's fixed. Because quite frankly, if we send them home, they might not come back. Also, idle time has been very important here during the pandemic because businesses don't always have something for employees to work on. So some businesses chose to pay their employees, even though there was nothing to work on. That is idle time. If they laid them off, then no idle time. Then in number 3, there are 2 different definitions here that I would like for you to know. First of all, prime costs. That means direct manufacturing costs, or in other words, direct labor plus direct materials. And second, conversion costs. Those are the costs we incur to convert the raw materials into finished goods. So conversion costs are direct labor plus factory overhead. Then number 4, something that I'm clarifying here that we've seen is that all manufacturing costs are product cost. In other words, direct labor, direct materials, and factory overhead. No non-manufacturing costs, meaning upstream and downstream costs, are ever capitalized as product cost. Their expense is incurred. So as soon as a business spends $1 on research and development with its engineers, that dollar hits the income statement as an expense. Then number 5, the above classification is based on the 3-part classification companies normally use, which are separate classifications for direct materials, direct labor, and overhead. And we'll use the 2-part classification method only in a few circumstances in this course. Here, direct labor and overhead are grouped together as conversion costs, so we have only 2 product costs in that case, direct materials and conversion costs. We'll see in just a couple of places. And speaking of inventories, number 6, a manufacturing firm has 3 major inventories. So inventory number 1 in time is direct materials inventory, which consists of direct materials from the time of receipt from the vendor until the time we requisition them to the assembly line. And direct materials, also called stores, which is where the term storeroom comes from. So let me just write this down for you. So inventory number 1 in time will be direct materials. Sometimes we call that raw materials. Well, 6 of one, half a dozen of another, basically. I will show you. So direct materials, we buy them from a vendor unless we are vertically integrated and produce our own direct materials, in which case we probably have a separate subsidiary that does that. Well then, inventory number 2 in time, work in process inventory, consisting of unfinished goods on the assembly line. And direct materials, direct labor, and overhead are accumulated as products progress down the assembly line. So as those Legos went down the assembly line, they incurred more and more direct materials like some ink on them, some adhesive glue on them, more and more direct labor, and more overhead. Let me just draw this for you. So with work in process, inventory, number 2 in time. So there's the assembly line. We transfer direct materials to the assembly line, and on the assembly line, as units roll down it, we place more and more direct materials into them. More and more direct labor goes into them because assembly line workers are working on them, and more overhead will go into them too. So as the product progresses down the assembly line, its cost will go up. Its product cost will go up, and we'll do that in the next chapter in numbers again. Then inventory number 3 in time, finished goods inventory, consisting of completed units from when they roll off the assembly line until they are sold. So inventory number 3 in time, be finished goods inventory. So again, consisting of units rolling off the assembly line and into finished goods. If our factory had a showroom, a sales floor, in other words, where they sell product, then that would be finished goods inventory. Then, just to let you know, let me draw this up here too. at the point of sale. Whoops. Well, finished goods, they will no longer be an asset. Instead, they will transform into an expense called cost of goods sold because we no longer own them. Okay, there we go. Place of a board. I wish I had one of those little chalkboards that children have. So at that point of sale, we no longer have an asset. We no longer have inventory. Instead, it transforms into cost of goods sold. So it's now expensed. Very good example of that in Ireland a couple of years ago when I visited the Waterford Crystal Factory in Waterford, Ireland. They did have a factory floor in there, and what they produced, well, right after they took us through the manufacturing process, guess what? They took us into the showroom, so the sales floor, so you could buy what was produced. So, yeah. There on the sales floor, we had finished goods inventory. Back on the assembly line, we had work in process inventory. And of course, once finished goods were sold, that was cost of goods sold. Their inventory was pretty pricey, by the way, so I didn't buy any. I don't think most accountants would have. Well, then D, just to let you know, the manufacturing supplies inventory is sometimes mentioned. And it just consists of indirect materials from the time of purchase until the time of requisition to the assembly line. By the way, direct materials plus indirect materials equals raw materials. Some businesses use the term raw materials as a synonym for direct materials because indirect materials just isn't very large. So if I say raw materials, if I say direct materials, same thing, 6 of one, half a dozen of another. By the way, in Lego video that you saw, or I'm sure we'll see soon, if you haven't already, it takes you through, first of all, through the manufacturing process of Lego bricks in the factory in Denmark. So in that, you saw raw materials consisting of plastic particles, which by the way come from China, and also dye that they put into the Lego bricks so they can be red or yellow or blue. So those are raw or direct materials. You did see a human transferring some of that to the assembly line. That human would be direct labor. However, most of the manufacturing process is very automated. More machines than people. We often say that is a capital-intensive process. More machines than people, machines are assets, capital. So you saw the assembly line there as Lego bricks were being manufactured, and also as things such as the Harry Potter figurines were being manufactured too. Then overhead, you saw things like lights on in the factory. You saw the machines at work, etc. All that implies electricity. Of course, on the factory building and factory equipment, we have depreciation. And by the way, in Denmark, does anybody know how Denmark generates most of its electricity? Anybody know? Through which means? Take a guess. Somebody. Nobody knows? Do you think it's oil? Coal? No, it's a clean means. No guesses?
Water.
Pardon?
Water.
Actually not, but surrounded by water. But that ties in to the method they use. No ideas? You'll kick yourself. Wind. Yeah, wind. They generate most of their electricity by wind. They have many huge wind turbines. And I remember the first time I flew into Copenhagen some years back, in the water just off Copenhagen between there and Sweden, it's called the Øresund. they had about 24 huge wind turbines I saw from the plane as we flew in. So very representative of how Denmark generates its electricity. And it prides itself on being a very green country, a very clean country. So what you saw there in the Lego factory, the electricity is coming from wind. So you saw that very capital intensive process, first of all, of manufacturing the Lego bricks and simple figurines like Harry Potter. Then you saw a second manufacturing process, which was very labor intensive, more people to machines. And that was in putting together the big Lego figures, the big Lego sculptures. So you saw those being put together. Somebody was actually hammering the Lego bricks into place. And that was being done in Denmark. That video was filmed before they started manufacturing those large objects in Lake Wales or Legoland in Winter Haven and also other Legolands here in the United States. And by the way, those large sculptures are very valuable, and they've had a few stolen along the way too. So they're now safeguarding those better. Has anyone been to Legoland? Whether here or someplace else? I got to go for free as part of Student Accounting Society, and I'm glad I did because it's not cheap to get in there. But they have very large Lego sculptures, including a huge relief map of Florida with some major Florida attractions. And that includes in Polk County, Bok Tower, and also from Florida Southern, the Annie Pfeiffer Chapel. So it's very impressive to see it. And Legoland, it's someplace good for children, but for adults, I certainly wouldn't recommend paying the price because that was about 4 years ago. And I remember it was $95 to get in then. Not cheap. Well, let me come back to the questions at the end of the chapter, at the end of this outline. And do you have any questions though so far? Anything I can clear up for you? Nothing? Okay. Let's see why it didn't do. Let's come to 2 and 3. So items 2 and 3 are based on the following information. We've got Metallic Slugger Corporation manufacturing aluminum baseball bats. And obviously that fictitious name is based on which real-life manufacturer of aluminum baseball bats? Anybody know? Louisville Slugger. Yes. So we've got the following manufacturing costs for the year. And let me see in 2 and 3 what we are asked to find. Number 2, direct manufacturing labor cost. Number 3, direct materials cost. So let me look for those as I go through. Well, first, when it comes to labor, we've got these wages up here. So pick out what is direct. So first of all, machine operators. Those are the assembly line workers operating machines on the assembly line. Would you say that is direct or indirect labor? Direct. Then maintenance workers. Would that be direct or indirect labor? Indirect, because they are not directly producing products. Machine operators are. The plant supervisor, well, anybody in some supervisory or administrative role would be indirect labor, as we saw. So we have $300,000 of direct labor, $125,000 of indirect labor. So to answer number 2, direct labor is A, 300,000. Then number 3, dealing with direct materials costs. First, we have aluminum. Would you say that is direct or indirect? Direct. Then adhesive glue, that could go either way. That is a minor material, which we could technically trace as a direct cost, or it's so minor that we might just lump it into overhead for simplicity. It is the company's choice. Then rubber grips on the baseball bats, those are obviously direct materials. So number 3, direct materials cost was, you could have 2 possible answers. If you add all 3 of these up, you would have answer D, 1.1 million. If you assumed all 3 were direct materials. Or you can have C if instead you assume that adhesive glue is an indirect material. So either C or D would be correct for number 3. By the way, on an exam, I would give you something with only one clear choice. So I wouldn't give you something like number 3. Just wanted to include that here to illustrate the point about minor products or minor materials like adhesive glue.
Would you tell us if it's direct or indirect for that company?
Yes, I would. I would make sure that I clarified it so that you would have only one correct multiple choice answer. Yeah. Otherwise, I would give you credit for both, but that would be a mistake if I included that. Earlier, did we do number 6? Can't remember. If we
No,
did.
No, we didn't. No.
Okay. Well, which sector companies have no inventories on their balance sheet? That would be A, service sector companies. Then number 8, the 3 categories of inventories commonly found in many manufacturing sector companies are, wouldn't be A, wouldn't be B, C, raw or direct materials. That's inventory number 1. Work in process, inventory number 2. Finished goods, inventory number 3, as we know. So number 8, the answer is C. Pardon my blank page there. Then number 9, for financial statement preparation purposes, the cost of products includes first only the cost of manufacturing. The answer is yes. That means direct materials, direct labor, and overhead. Does it include all costs of running the business? That would mean also upstream and downstream costs. The answer is no. So go for A for number 9. The answer is A. 10, we will get more into this in the next chapter. Direct and indirect costs are assigned to cost objects as follows. We will use cost allocation or averaging costs out for indirect costs. We will use cost tracing, which means tracing the exact amount of the cost for direct costs. So in number 10, the answer is B. Again, more about that after the next chapter. So that takes care of all the multiple choice questions. Any questions on any of those? Okay. Let me come back up to where we left off in the outline. We're almost done. And good. So we're just ready here for the next little section, which is Roman numeral 4. So the income statement and supporting schedule of cost of goods manufactured for a manufacturing sector company. So I'll be showing you this from the book, page 873 and also 874. I won't be very concerned about the computation of unit costs. So as we go through this income statement, and there'll be a supporting schedule for it, cost of goods manufactured, the cost of what we produce. Well, we will have 3 inventories to account for: direct materials, work in process, and finished goods. Manufacturing supplies or indirect materials, a very minor inventory, we won't worry about it. So we'll account for all 3 of these inventories on the income statement, as you'll see. And then in B, we will simply manipulate account activity for each inventory to find the decrease in each inventory balance. By saying account activity over a period of time, here's what I mean. The beginning balance of the account plus any increases over the year minus any decreases during the year equals the ending balance. But here's the trick. We need to know what increases and decreases each inventory account. So we'll account for all three on the income statement. You'll see how. Well, for direct materials, the increase will be purchases. The decrease will be the amount of direct materials requisitioned to production, or in other words, used. The term requisitioned means that it's internally transferred from direct materials inventory to work in process inventory. Now, with work in process, what increases it? Well, the direct materials used will. Also, direct labor will increase it, and the amount of overhead that's applied or allocated. What will decrease work in process will be cost of goods manufactured. CGM is the abbreviation for it, which we'll use a lot. So the cost of those goods rolling off the assembly line will decrease work in process. In turn, that will increase finished goods. So cost of goods manufactured, they roll off the assembly line and roll into finished goods. Then what will decrease finished goods will be cost of goods sold. So what we sell, and that becomes an expense, of course, at the time of sale, the point of sale. So let me turn to page 874 in the book. And show you the body of the income statement for a manufacturing sector company. By the way, we have two columns in this. You may recall from financial accounting that we have total amounts in the right-hand column, just like on an Excel spreadsheet. For any further detail, we have that in the left-hand column. Or for even further detail, we might have a third column over here, further to the left. So just like on the income statement for a merchandising sector company, we have net sales revenue up top. In this case, $1 million. We will then subtract cost of goods sold. I will get to that in a moment. $600,000 to get gross profit, sometimes called gross margin, of $400,000. Then they subtract selling and administrative expenses. Same thing as operating expenses, same thing as upstream and downstream costs. So selling and administrative expenses or operating expenses or upstream and downstream costs. These are very typical. Wages expense, rent expense, insurance expense, depreciation expense, supplies expense. A total of $241,000. Subtracting that from gross profit gives operating income of $159,000. Don't worry about what's below that. Now, what I do want to show you is to come back up here to cost of goods sold, because we have a further breakdown here of what goes into it. It is much like accounting for merchandise inventory in a retailer, in a merchandising sector company. So here's what we do. We start off with beginning inventory. Instead of beginning merchandise, it's beginning finished goods inventory. In this case, zero. This company had nothing to start with. It just started up its operations this year. Then cost of goods manufactured. Well, instead of purchases, as we would have for a merchandising company, we have cost of goods manufactured. How much we spent to make them. And we will calculate that in just a moment on another schedule. So this is giving us, with these two numbers, where finished goods inventory has come from. We have cost of goods available for sale, or the total array of goods for sale at some time during the period, the grand total of $660,000. Then, if we count ending finished goods inventory is $60,000, We can bear in mind that that is one place where finished goods inventory will go. It'll be there at the end of the year. The other place finished goods inventory will go is to be sold, $600,000. So we just accounted there for inventory number 3 in time, finished goods. Again, to get the decrease in it, which is cost of goods sold. So any questions so far about the income statement? Okay. Now, if I go to the previous page, I will show you where cost of goods manufactured came from. It's going to come from what we call a supporting schedule for the income statement. We will account for the 2 remaining inventories here. We will account for direct materials and work in process. So up here at the top, they have work in process 80,000. By the way, I will not have you write out one of these from scratch or the income statement. Instead, I would simply ask you to calculate numbers from it. So beginning work in process 80,000. Then they account for direct materials inventory. So inventory number 1 in time, direct materials. We first chart out where direct materials came from. Either it was on hand as beginning inventory, 70,000, or we purchased it during the period, 350,000. Purchases, they remind us, will include freight in or shipping charges, which we had to pay to get that to us. So that's where direct materials came from. Either it was on hand as beginning inventory or we purchased it. That gives us a grand total of direct materials available for use of $420,000. There is the total array of direct materials available for use in our storeroom at some time during the period. Then we chart out where direct materials went. Either they were on hand as ending direct materials. If we subtract that away, we get direct materials used of $355,000. Any questions there on direct materials? Okay. Now, direct materials used. That amount is a reduction in the direct materials inventory account. So there's the decrease, which was our goal to find. In turn, that is an increase in work in process inventory. So now let's account for work in process inventory or inventory number 2 in time. We already had beginning work in process up top. That is one place where it comes from during the year. It was on hand at the beginning of the year. The other place work in process will come from will be these 3 amounts which increase it. Direct materials, direct labor, which is $169,000, and overhead, which is $83,000. Just to take a look at their further breakdown of overhead for a moment, we notice they have 3 columns here. So this very left-hand column has lots of detail in it. So overhead, very typical items. They have indirect materials, indirect labor, depreciation on the plant or the factory and equipment, and plant utilities, insurance, and property taxes, a grand total of $83,000. So all 3 of these represent total manufacturing costs incurred during the year of $607,000. So that is the other place the work in process came from. These 3 product costs, they increased work in process. If we add that to beginning work in process of $80,000, we get total manufacturing cost to account for of $687,000. So there's the grand total for the year, all the total manufacturing costs. So we know where they came from. Again, either beginning work in process or manufacturing costs incurred during the year. Now we know where they went. So charting out where work in process goes, Either it was on hand as ending work in process, we can count it, 27,000. That's what's on the assembly line, by the way, at the end of the year. If we subtract that, we get cost of goods manufactured, or the other place the work in process is going, 660,000. That represents the decrease in work in process inventory during the year. It rolled out of work in process. It rolled into finished goods inventory. That's why we saw it as an increase in finished goods on the body of the income statement itself. So any questions about the income statement? We'll work more with these costs, by the way, in chapter 17. So they'll make lots of sense then. But as long as you can pretty well follow along on the income statement, we're good for now. Look okay? Any questions? Okay. Almost done over here with the notes. Whoops. See if you have a chance. It just breaks down the income statement in Exhibit 1614. If you understand the income statement for now, I don't think you need to worry about that. Same story for D. Okay, so that takes care of chapter 16. Do you have any questions about 16? Anything I can help you with there? Okay. Did you have anything on chapter 15, the previous chapter? Any questions for me at this juncture? It was a pretty easy chapter. Okay. Chapter 16 is not too bad either. So certainly as you encounter questions, please just let me know. Always glad to help you out. Never a problem. And I've recorded this session, so I will post that on YouTube and send everybody the link in case you need to review something from it. Other than that, we'll worry about chapter 17 when we come back here on Wednesday. So again, if you choose to come live, that's great. If you choose to watch the recording instead, that's great too. Doesn't matter, it's always your choice. Well, thank you very much, and that takes care of tonight's session.
See ya. Thank you.
See you, Professor.
I have a question about Pearson.
Yes.
So is there a code, or do we just get the book and
No.
it comes in it?
Just go in through my accounting lab, and it will prompt you to buy a code if you don't have one. Hopefully your code from 2111 works if you just had it.
Okay.
Okay, but just go in through Canvas and you'll see a link on the left-hand side for what's called MyLab/Mastery.
So, question, Brianna, do you just need, is this all you need?
Yeah, I took accounting like my freshman year, so I don't have the code, but I didn't know if I should get a new book or anything.
Oh, because I accidentally got a second one by mistake.
Oh,
Do you want to buy mine? I'll send it to you.
yeah, possibly. I'm going to the bookstore
me
tomorrow,
know.
but I'll let you know on Wednesday.
Yeah, let me know and I'll send it to you immediately.
Great, thank you.
Yeah, you're welcome.
Yeah,
That,
otherwise,
then return it. Yeah.
otherwise, Rose, we'll find a buyer for it. And if worst comes to worst, we'll find a buyer in the spring. Okay.
Right, thank you.
Thank you.
Thanks. No questions? All righty. Have a good one.
Doodle.
Wednesday. Thanks. Bye-bye.